Scott, you were speaking on the analyst call after your most recent quarterly report earlier this morning, saying that oil could easily go to $150 a barrel in the coming months, but that won't change your production plans and your growth rate of 5% a year. If other players in the shale patch don't follow suit, where is that going to leave Pioneer?
Yeah, thanks, Kailey. It's great to be with you and Guy today. We have committed to our long-term shareholders. We'll be growing 0 to 5% regardless of the oil price. Obviously, we're going to be sending 80% of our cash flow back in form of dividends to our investors. In addition, we've announced a $4 billion stock buyback. So it's been well received, both the dividend and the stock buyback. In that regard, we'll continue. In fact, fourth quarter, we sent over 100% of our free cash flow back to the investor. About half the independents, the public independents, are adhering to that 0 to 5%. A few privates are growing faster. And I have stated publicly their inventory will be depleted fairly quickly going forward. So I just don't see U.S. production contributing the amount of barrels that it has as it has over the last several years.
Scott, it's Guy. Can you just talk to me about how you think that private operators should be, quote, reined in? What does that actually look like?
No, I showed, this is a flaring chart from Rystad. They collect the data from all the shale basins from the regulatory bodies in each state. And we still have several privates well over 1% flaring. We need to rein them in, a combination of both state regulatory bodies and EPA under the federal guidelines, the federal bodies, and also investors, whether they're bond investors, private equity investors, or public investors. The privates need to rein in so we can reduce that black eye in these shale basins.
Well, Scott, a story we have been following over many weeks, and once again today, is geopolitics, the situation on the border with Ukraine and potential Russian action, which of course Russia denies. Should there actually be armed conflict, should that result in a disruption of energy flows, would Pioneer in that scenario potentially increase production to help make up any potential shortfall?
No, Pioneer will stay with our plan. We announced a CapEx plan, as I said, regardless of whether it's $150 oil, $200 oil, or $100 oil, we're not going to change our growth plans. It's going to be up to Saudi and UAE. They have a pact with OPEC+. They probably are about the only two countries that could change that, and they'll have to decide what to do under that scenario. If Russian oil is sanctioned, or if Russia decides to stop exporting, then it's going to be up to the Saudis and UAEs to decide whether or not to break the pact and increase production under those guidelines.
So if the president phoned you up, Scott, and said, you know what, we need some more oil, what are you going to say to him?
I'll tell him we have a pact with it's all about the shareholders. Our shareholders own this company. They want a return of cash. We know what's happened when we increase U.S. shale too much over the last 10 years. So we've had a collapse. And so we are growing. What's good, we are growing 5% long term. And that's probably good enough for hopefully it's good enough for the president if he calls me.
All right, well, let us know if that day happens. We would love to talk to you about that conversation, Scott. In terms of what your shareholders want, obviously you're prioritizing returning money to them. Does that mean no M&A is on the table at the moment?
No M&A at all. What we're doing, I answered on the call, we're doing small deals. We're buying small deals. We're selling small deals. But Pioneer has the longest inventory of anybody in U.S. shale. It's 15 to 20 years. There's no reason to buy anybody on large M&A. We got the greatest dividend, the highest dividend of the S&P 500.
Scott, what kind of inflation are you seeing right now? Where are the bottlenecks? Where are you struggling? Is it people? Is it materials? What's the story?
No, being the largest Permian Basin operator, producer and also the most with drilling rigs. We get the best cost in the basin. We've seen about a 10 to 15% increase over the last second half of 2021. We're seeing probably a 5 to 7% increase in 22. That's built into our CapEx guidance. And so besides that, Pioneer is set. Now, several other producers are having trouble getting frac crews. They're having trouble getting labor, and they're having trouble getting sand. And so that is an issue, and that's going to keep anybody from growing. Even if the president wants us to grow, I just don't think the industry could grow anyway.
Finally, Scott, we began this conversation with your statement that we could see oil going to $150 in the coming months. When will we see that come down and supply and demand come more into balance? What is your expectation?
Yeah, I've been through 6 cycles over the last 40 years in the industry. This is the last time we had a demand cycle was back in 1980-81. Oil was about 15 and went to $50. We had spot market up to $100 at that point in time, and so it has to get to a price where people reduce demand. And most people are saying that's around $150 oil.
Yep.
And so,
Scott, it's always great to catch up. We're going to leave it there. Thank you very much indeed. We're seeing a little bit of scratch on the mic there, so we're going to leave the conversation. Scott Sheffield, Pioneer Natural Resources CEO.